Welcome back to Morning Trade Live. Let's do some trading. Let's look at some options. Let's look at some action. We got Tesla down right now this morning. Definitely the biggest mover. Tom White here with me in studio, and Adam Coons joins us from Winthrop Capital Management, Chief Investment Officer on the line. Tom, these numbers for Tesla weren't fantastic, but also, isn't it kind of understood that car sales are going to be under pressure?
Well, the stocks, the way that the stocks moved, you know, the nearly 65% gains that we saw in 2024 weren't based on auto sales at all.
Right.
It's about the optimism that the new administration is going to be more friendly to Elon Musk. So you think these numbers should matter. That's why the stock's down. But we're almost $15 off the session lows already because people, hey, they rallied this stock on the basis of, hey, we're going to have humanoid robotics. We're going to have the cybercab coming up, and we're going to have an administration that's going to allow Elon Musk to do whatever he wants.
Right.
So yeah, not
some
surprising.
Decent dip buying ammo in that narrative.
Yeah, I don't know if this dip buying lasts though. I mean that number was a big miss, and it kind of is reflective of the EV space in general. I think it's going to be drawn out that we're going to get a rebound in EV sales where they're going to see growth numbers like they did in 2022 and early 2023.
We're down $17 almost. Adam, what do you think? Happy New Year. Good to see you again. Tesla car sales going to matter?
Yeah, ultimately they do. I think you're spot on with this is really a narrative trade right now, post the election. And so when you see the stock up, like I said, over 50%, it was more than priced to perfection. So having a miss like this, I'm surprised it's not down more, but there just is enough momentum and a narrative story to support the stock right now. But I think it's just set up for really high expectations. And so that's why we're staying away from it. Would I short the stock? Not at all. But for us, we've stayed away from it. We've kept it out of our portfolios because of the amount of volatility and uncertainty. And this is just a story around autonomous driving and the fact that there might be a lower regulatory environment. But I think that's really a tough case to make. Trump alone isn't going to be able to make big moves there. It's going to be more at the state level. And so I think this is a harder path than what investors are kind of giving credit to the stock.
How do you feel about the opportunity cost of withholding Tesla relative to the index, the top 10 stock in the S&P, but only a couple percent, but obviously that's a pretty chunky weighting. Do you find that clients are okay with missing out on that potential upside? Is it just that, hey, you're still going to have the other big ones, or what's kind of logic they're connecting back to the whole market?
Well, we know as investors, it is tough when a stock is up 50% and you don't hold it. That's a difficult story. On the other side, you don't hear about as much of a win when it's down 50% and you didn't hold it. But it's one of those where I think there are enough other investment stories out there that if you don't hold this one stock and you can find other ways to add alpha. Very explainable, especially when you're talking about a stock, like I said, that just really is so story based, and that can work with a smaller stock. But something that is such a big weight of the S&P, such a large market cap, that's just a big risk to put into a portfolio in our mind. So,
fair enough.
We don't take big active bets against the index, but this is definitely one of them.
All right, fair enough. Hey, Tom, let's look at the options. What's going on in the volatility for Tesla right now?
Yeah, IV percentile rank still about 70%. So it's in the top 2/3 basically of what implied volatility levels have been over the last 52 weeks. So that provides some opportunities for some option strategies, but while still staying risk defined, giving myself maybe a cushion. So I looked at something neutral to bearish in here going out to the January 17th monthly cycle. So just a couple weeks till expiration on this one. And I looked at selling it out of the money call vertical, sell the 400 strike call, and then buy the 420 strike call. So a short, neutral to bearish $20 wide call vertical. I'm collecting roughly about a $5.50, $6 credit on this.
Ooh,
that
not
credit,
bad.
Yeah, the credit that you collect is what you can potentially make on this. If you collect $5.50 credit, takes your break even to $405.50. Over the next 15 days. That's about 5.5% above the current share price in there. And you're taking advantage of that higher implied volatility, which allows you to collect more option premium on these. You have a better probability of success on this type of trade because it is out of the money to the upside. So you'd need something to spark it to go above that break
You're
even.
basically betting that the chart kind of broke this morning.
Yes.
Because the bet against it going above 405 is basically the bet against it going back. It's through the support that just broke this morning, because there was pretty clear support at about 405, right above 400 that it had tried a few times in the last month and it held.
Yep, and like I said, it takes advantage of the higher implied volatility where, hey, I can take a bearish bet on it. I can stay risk defined because I know what my downside is on this one because I did sell a spread as opposed to a naked short call.
You're selling the 420.
Yeah, and I'm giving myself better probability of success. And hey, I profit in 3 out of 4 scenarios. Stock goes down, stays where it is, or goes higher but remains below that 405.50 break even. I'm going to be profitable in this one.
All right. I don't hate it.
Yeah.
If you want to take a stab at Tesla by selling upside after this morning's break. Let's talk about a stock you do like, Adam. Crowdstrike, the cyber trade, seems to be resilient. Amazing comeback story last year.
Yeah, I mean, this was a tough one, obviously, to hold through the summer with obviously the events that hit, a lot of different companies. It seemed like everything was shut down for a day. And so you have seen the stock pretty much regain all of that. So we were buying tremendously after that event. We didn't see any real change from the actual business and the momentum it had. And in general, we like the space. We like Fortinet as well. But CrowdStrike is our favorite. We hold both. And I think when you look at, okay, how can we play the AI story and not get caught up too much in these ideas, and like I said, I'm going to keep saying it, the narrative trade, because we try to stay away from that. And I think in large part that's what kind of the AI story was through kind of the first half of the year. So we looked at cybersecurity as a way to play the growth in AI, but with a more measurable approach. And so when you look at something like CrowdStrike, sure, valuations might be a little bit tough to stomach, but when you look at the growth potential and the obvious necessity of a different generation of cybersecurity, CrowdStrike is the leader in that. And so when you look at the adoption of Falcon, for example, within their product pipeline, it just shows that this is a pie. When you talk, this is probably an overused phrase, but this is definitely a pie that is growing and we know will continue to grow because AI is only going to make cybersecurity more complicated, which means there's going to be, from a business standpoint, makes it, more billable at a higher rate. And so that's why we like the space, and in particular, CrowdStrike.
Love it. Case well made. Thanks, Adam. Appreciate that.
Thank you.
Good stuff. All right, Tom, give me the bull trade for CrowdStrike.
Yeah, you saw that chart on CrowdStrike. We're above those levels, or right at those levels that we were prior to that outage in July. So it's made up all that ground. Was up over 34% last year. So I talked about high implied volatility in Tesla and selling a vertical to take advantage of that high implied volatility. On the flip side, CrowdStrike, their IV percentile ranks only about 20%. So in the bottom 1/5 of implied volatility levels that we've seen over the last 52 weeks. So taking advantage of that with a directional play based on what Adam thinks here. If you like CrowdStrike and think it's going to go higher, I went out to the February monthly cycle. So 50 days to expiration on this one, nearly 2 months. So I'm giving myself duration. There's no earnings until early March, so it avoids that. But if you think it's going to grind higher, this strategy takes advantage of it. Buy a slightly in the money 340 strike call in CrowdStrike. And then against it, because I want to offset some of my risk on this, sell the 380 strike call. So a $40 wide bullish call vertical to the upside, paying roughly about a $16, it might be about a $17 debit right now. But if you pay a $16 debit, the debit you pay is going to be your risk on this one. And it takes your break even up to 356 over the next 50 days. That's only about 3.5, just over 3% above the current share price. So you don't need a monster move to the upside, but you just want it to maybe go back towards those all-time highs that we saw last year ahead of that outage. But this takes advantage of upside. It takes advantage of low implied volatility because a vertical like this, when you're buying it and implied vol's low, you pay less for it, and that's your risk on this trade.
So even if vol does pick up, you'll be all right?
Yep.
You don't mind that?
Yep, that'll expand the price too. But if the stock grinds up, you would expect implied volatility levels to stay low.
Okay, so you got a few ways to win there. Pretty good probability trade for upside. Thanks, Tom.